Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Meta.
If you find our talks useful, please consider subscribe, like, and comment underneath. We are moving far past this outdated narrative of a simple social media app for keeping up with your extended family.
Oh, absolutely. I mean, those days are long gone.
Right, totally gone.
Yeah.
Today, our core mission is unpacking why the market is treating this company not just as a participant, but as an absolute powerhouse in the artificial intelligence monetization race.
Yeah, and that distinction is huge for anyone managing their own money.
Exactly. When you are looking at your portfolio, trying to identify those multi-year holds, you really have to understand the mechanics of what is actually driving value under the hood.
You have to separate the AI hype from the actual math.
Precisely. So we are going to explore the massive revenue beats they just posted, the truly staggering infrastructure costs they're taking on, and ultimately figure out whether the stock's current momentum makes it a foundational pillar for your long-term wealth building.
Yeah, because the broader tech sector is just full of companies promising that AI will eventually make them money someday.
Someday, right. But it's always tomorrow.
Exactly. What the latest data shows is that for this specific company, the transition from futuristic hype to, heavy present-day cash flow has officially happened.
Well, before we crown them the permanent king of AI, we really need to look at the actual scoreboard.
Fair enough. Let's look at the numbers.
Because we need to look at the immediate payoff to understand why the market is reacting this way right now. The numbers for 2025 just came in, and I mean, they are enormous.
They really are.
We are looking at roughly $201 billion in revenue for the year. That is 22% year-over-year growth.
Which is wild for a company of that massive scale.
It's insane. And what stands out even more is that the growth actually accelerated as the year closed out. I mean, Q4 revenue rose 24%.
Yeah, and the underlying mechanics of that growth are what should really matter to you as an investor.
Right. It's not just the top line number.
Exactly. It's not just that revenue went up, it is how they achieved that revenue. They saw an 18% jump in ad impressions, meaning they are successfully showing more ads to users.
Okay, so volume is up?
Volume is up, but simultaneously, they saw a 6% increase in the average ad price.
Wait, hold on. In any traditional business, if you flood the market with more inventory, the price per unit is supposed to drop, right?
That is the standard law of supply and demand, yes.
So increasing your volume while simultaneously increasing your pricing power, that completely breaks the normal laws of economics.
It does. It is the absolute holy grail of a fundamental business model.
It's like they somehow upgraded the engine of a massive cargo ship while it was moving at top speed across the ocean.
That's a great way to put it.
They didn't have to pull into dry dock to retool. They just swapped out the parts mid-journey, and suddenly the ship is moving 20% faster.
And carrying more expensive freight, too.
Right. But when you are managing your own money, you have to ask the hard questions. So let me push back a bit here.
Go for it.
Is this explosive growth actually thanks to their new AI tools? Or are we just looking at a macro recovery in digital advertising that's masking as an AI victory?
I hear that argument a lot.
Because we know the broader digital ad market has bounced back, as inflation cooled and consumer spending stabilized. Are they just riding a rising macroeconomic tide?
Well, if it were just a rising tide, you would see steady, single-digit growth across the board that mirrored their competitors.
Right. Everyone would be up the same amount.
Exactly. Instead, we are seeing massive revenue spikes directly tied to AI rollouts that their competitors simply do not have.
Like what specifically?
Their AI-driven video generation tools, for instance. Those are already operating at a $10 billion run rate.
$10 billion? Wow.
$10 billion annualized from a capability that basically barely existed in a commercial sense just a short time ago. The AI is actively improving their ad targeting and incremental attribution at a multi-billion-dollar scale.
Okay, so incremental attribution is one of those phrases that Wall Street loves to just throw around to sound smart.
Oh, absolutely. It's a buzzword.
Let's break down the actual mechanism for the listener. What does that mean for the business owner buying the ads, and why does that translate to a higher stock price for you, the investor holding the shares?
Okay, so in the past, an advertiser might spend $10,000 on a campaign based on broad demographic guesses.
Like targeting men aged 25 to 40.
Exactly. They hoped it reached the right people, but proving that a specific ad led to a specific sale was incredibly difficult.
Half the money is wasted, you just don't know which half.
Right. But today, the AI models analyze thousands of behavioral data points in real time, to place that ad exactly where it has the highest probability of converting into a sale.
So the targeting is hyper-specific.
Hyper-specific. But more importantly, the system proves to the advertiser exactly which ad drove the purchase. That proof is the attribution part.
Ah, so they literally hand you the receipt saying, our AI made you this money.
Exactly.
Huh.
And because the AI is so efficient at proving its own worth, advertisers are more than willing to pay that 6% premium on ad prices.
Because they know it works.
Right. The AI is fundamentally proving its own return on investment. That dynamic is why their Q1 2026 guidance came in at a massive range of $53.5 to $56.5 billion.
Which completely crushed the Wall Street consensus of $51 billion.
Blew it out of the water.
Okay, so they have the pricing power. But, that pricing power is incredibly fragile if an advertiser can just take their budget to a competitor.
Sure, if the users leave, the advertisers leave.
Right. It's one thing to have great AI that targets ads, but if nobody is looking at the screen, none of this matters. So we need to understand exactly where this engagement is coming from and why competitors can't easily steal it.
Well, the sheer scale of their ecosystem becomes the ultimate defensive asset for your portfolio here.
How so?
We are looking at a scenario where Instagram Reels watch time grew by 30% year over year in the US during Q4 alone.
30%. That is a massive jump for a platform that was already ubiquitous. I mean, everyone constantly talks about TikTok eating their lunch.
That's been the narrative for years.
Right. For the last 3 years, the story has been that younger demographics are permanently fleeing to other platforms. Looking at this 30% jump in Reels and the massive revenue beats, how are they actually keeping advertisers locked into their ecosystem instead of defecting?
It comes down to network effects combined with the Advantage Plus system, which creates insurmountable switching costs.
Insurmountable switching costs. Explain that.
TikTok is highly engaging, sure, but it doesn't have the holistic view of a user that comes from seeing their social posts, their business messages, and their shopping habits all in one unified place.
Because they have the whole suite of apps.
Exactly. When you have Facebook, Instagram, WhatsApp, and Threads all feeding data into the same central AI brain, you create a map of consumer behavior that literally nobody else can replicate.
And the Advantage Plus platform is the perfect example of this. The numbers on that are just mind-bending.
It really are.
The Advantage Plus AI ad automation platform is now operating at a $60 billion run rate.
60 billion. Just let that sink in.
It's staggering. So instead of a human media buyer throwing a dart blindfolded, hoping to hit a target demographic, Advantage Plus is it's like a swarm of a million microscopic drones.
That's a vivid analogy.
It tests every single possible creative variation, every possible audience segment, instantly across all their platforms, and only charges the advertiser for the drone that hits the bullseye.
And when you are evaluating a stock for a 5-year hold, you are looking for that exact kind of switching cost.
Because it locks the customer in.
Right. An advertiser gives Advantage Plus a budget, and the AI handles the rest. If you are a business owner and this system is driving your cost per acquisition down by 20% compared to other platforms, you literally cannot afford to move your ad budget anywhere else.
You'd be losing money by leaving.
Exactly. As an investor, that is the ultimate downside protection. You are locked in. And this ecosystem lock-in leads us to the real hidden gold mine of this quarter's data.
Business messaging. Because WhatsApp has historically been the giant question mark for this company, I mean, they bought it for billions. Over a billion people use it daily. But making money off it without ruining the user experience just seemed practically impossible for a decade.
People hated the idea of ads in their private chats.
Right. So how are they suddenly pulling a $2 billion annual run rate out of a free messaging app?
They finally cracked the code by turning it into a seamless customer service and direct sales channel.
Okay, how does that work in practice?
It's click-to-message ads. So user clicks an ad on Instagram, and it opens a direct WhatsApp chat with the business. Those specific ads are up over 50% in the U.S.
Oh, wow, 50% growth.
Yeah. The paid messaging segment has crossed that huge $2 billion milestone because businesses are realizing that conversing with a customer directly on their phone's native chat app converts at a drastically higher rate than sending them to a clunky mobile website.
It's just less friction.
Way less friction.
And they aren't just locking in the advertisers, they are applying immense pressure to the entire tech landscape with their open source llama models.
This is such a crucial piece of the puzzle.
Right, because Microsoft and OpenAI are spending billions trying to build these closed, paid ecosystems where you have to rent access to their AI brains.
The toll booth model.
Exactly. But by releasing powerful open source models for free, Meta disrupts that entirely.
It is a brilliant strategic maneuver. By giving Llama away for free, they commoditize the foundational AI layer. They basically destroy the business model of companies trying to charge a premium for AI access.
Because why pay for it when you can get it for free?
Exactly. If the AI itself is free and open to developers everywhere, the real financial value doesn't accrue to the company building the AI. It accrues to the company that controls the consumer application layer.
And since Meta dominates the application layer with billions of users?
They want the underlying AI to be as cheap and ubiquitous as possible. This forces the whole industry to build on top of their architecture.
Wow. And this open source strategy paves the way for a very speculative but highly anticipated horizon. We are seeing a lot of chatter in the research about Project Avocado.
Yes, slated for a mid-2026 launch.
Right. So this is an agentic AI designed for task delegation directly on WhatsApp and Instagram, meaning this is not just a chatbot that answers questions.
It's not just returning text.
Right. It's an AI agent that actually goes out and executes tasks for you, like booking a flight or ordering a product directly within the chat interface.
It transitions the platforms from passive media consumption to active daily utility. But building the computational infrastructure to support millions of AI agents acting simultaneously, processing complex tasks in real time, leads us directly into the biggest risk factor for the stock.
The heavy price tag.
The massive heavy price tag.
Because unprecedented growth and AI dominance require unimaginable computing power. The most controversial part of their balance sheet right now is the spending.
Without a doubt.
To put this in perspective for the listener, their 2026 capital expenditure guidance, so the money they are planning to spend on physical assets and infrastructure, is between $115 billion and $135 billion.
It's almost hard to comprehend that number.
That is just for AI data centers and the hardware to run them.
Yeah, to contextualize that staggering amount of capital, they are spending the equivalent of the entire market valuation of a massive Fortune 500 company in a single year, purely on infrastructure.
And we are seeing these massive recent deals cross the wire to support this. A $6 billion fiber optics deal with Corning.
Yep.
A $27 billion AI infrastructure deal with Nebius. Plus, they're rolling out 4 new in-house AI chips in collaboration with Broadcom to reduce their reliance on expensive third-party hardware.
Which is smart long-term, but brutally expensive short-term.
Extremely. They are pivoting from an asset-light software app to a heavy infrastructure builder. It is like a software company suddenly deciding it needs to lay physical railroad tracks across the entire globe.
It's a total business model shift.
So at what point does this massive spending crush their profit margins? Why is Wall Street looking at a $130 billion bill and seemingly forgiving them for it?
Well, the bear case, and the risk you always have to consider for your portfolio, is exactly that margin pressure.
If the AI investments fail to yield proportional revenue growth in the coming years.
Right. They might have to take on significant debt to sustain the build-out.
Yeah.
There's also the looming regulatory scrutiny over data and privacy. As these global AI systems scale up, regulators are already hawkish on tech monopolies.
Oh, I mean, imagine the regulatory nightmare when AI agents are processing payments, reading business interactions, and executing contracts on behalf of users.
The scrutiny will be relentless.
Relentless.
It will be. But Wall Street is currently rewarding the ad pricing power over punishing the massive capex hikes because of one vital financial metric.
Free cash flow.
Free cash flow. This is the crux of why the stock is up. Even after you subtract the tens of billions of dollars they are pouring into new data centers, their core advertising engine has such incredibly high gross margins, well over 80%, that it throws off mountains of pure cash.
It's basically a cash printing machine.
Exactly. They have so much cash left over that they are still aggressively funding share buybacks and paying quarterly dividends to investors.
Okay, let's really spell out the mechanics of that for the wealth builder listening. When a company buys back its own stock, it reduces the total number of shares available in the open market.
Right.
If the overall value of the company stays the same or grows, but there are fewer slices of the pie, your individual slice automatically becomes more valuable.
Precisely. It provides very clear cost parameters for the institutional investors analyzing the stock.
It limits the downside.
Exactly. When a company can spend $130 billion on future infrastructure while still returning billions to you today through buybacks and dividends, The downside is heavily protected.
So the market isn't panicking.
Not at all. The market is looking at this pivot and saying, yes, laying these new railroad tracks is unbelievably expensive, but they already own the absolute monopoly on the freight that will run on those tracks, and the freight is generating so much profit that it is paying for the tracks in real time.
The freight is paying for the tracks. I love that framing. And this brings us to the market reaction, the momentum, and the psychology of how this tug of war is being digested by the street.
It's been a wild ride.
We've seen the massive earnings beats. We've seen the terrifying bills. Let's look at the stock's actual performance. On January 29th, 2026, shares surged nearly 10% in a single session.
Incredible.
They added $170 billion to their market cap, pushing the overall valuation right to the edge of $2 trillion.
Yeah, and if you track the journey over the last 2 years, it has been a steady climb of institutional conviction. From the low 500s in early 2024, navigating through the initial skepticism about their spending, all the way up to the high 600s by February 2026.
We even saw a recent 2.3% gain that was specifically tied to the news of the Nebius and Broadcom AI deals.
Right. Wall Street saw a $27 billion invoice for servers, and the stock actually went up.
That's the definition of bullish sentiment.
It is. The sentiment score across institutional trading desks is incredibly bullish, registering at a 9 out of 10. JP Morgan just raised their price target to $825, maintaining an overweight rating.
Wow. And now you really can't read a financial newsletter without seeing speculative chatter about the stock potentially hitting $1,000 a share based on the future monetization of WhatsApp and Threads.
It is a remarkable shift in market psychology.
Yeah.
But, as an investor managing long-term wealth, you have to separate the signal from the noise and look at the underlying math of a $1,000 price target.
That is exactly where I want to challenge the euphoria for a second.
Okay, hit me.
We are seeing sympathy gains in peers like Google right now. Whenever a big AI infrastructure deal is announced, the whole sector jumps. So is this $1,000 a share talk actually rooted in unique defensible fundamentals? Or is this just a speculative rising tide lifting all the AI boats?
Are people just buying the hype?
Right. Are retail investors just throwing money at anything with the letters A and I attached to it?
Well, there is certainly retail euphoria in the broader market. I won't deny that.
Yeah.
But the fundamentals here strongly support a standalone valuation.
Based on the math.
Based on the math. If we look at the institutional accumulation, the massive pension funds and money managers buying the stock, they aren't buying the hype. They are buying the math.
And the math says 22% growth.
Exactly. The guidance for 22% growth on a revenue base that is already sitting at $200 billion is mathematically astonishing for a company of this size. The broader market might be lifting all boats, but this specific boat has an engine that is fundamentally superior to its peers right now.
Okay, so when we look at the upcoming catalysts, we have Q1 earnings coming up in late April or early May, and we know they have a slate of AI product reveals on the horizon.
Yep, lots of moving parts.
How should an investor position themselves based on everything we've unpacked today?
The investment thesis strongly points toward a multi-year hold strategy. The current price action is driven by the realization that their network moat is virtually impenetrable.
Because of that lock-in we talked about.
Exactly. Their ability to pivot a user base of billions into a highly targeted AI-driven ad ecosystem is working better than anyone on Wall Street predicted.
So the CapEx isn't a red flag.
Not if you look at the horizon. If you are building wealth over a 3 to 5 year horizon, the integration of custom in-house Broadcom chips lowers their long-term operating costs. These massive infrastructure partnerships set them up to dominate the 2026 AI product cycle.
It's a barrier to entry.
A massive one. That $130 billion capital expenditure is not a liability. It prevents any startup or even most mega-cap competitors from ever catching up.
They are outspending the competition so heavily that the game is effectively over before the next whistle even blows.
That's the reality of the situation.
It really forces you to reevaluate what this company actually represents within your portfolio.
Absolutely.
As we wrap up this analysis, I want to bring this right back to your personal wealth-building journey. We spend a lot of time looking at balance sheets, free cash flow, and revenue multiples.
The nuts and bolts.
Right. But generational wealth is built by understanding paradigm shifts before they become completely obvious to everyone else. Think back to the sheer utility of these upcoming AI agents we talked about.
Project Avocado.
Yes, Project Avocado. If millions of people start using their WhatsApp AI agent to book their flights, order their groceries, research local plumbers, and negotiate their daily purchases directly inside a chat window, a massive shift occurs.
It changes human behavior.
Exactly. Why would you ever need to open a traditional web browser again? Why would you go to a search engine to type in a query, scroll through links, and navigate clumsy websites when your agent can just handle the entire transaction seamlessly in the background?
The agent just becomes your interface for the internet.
Right. If this ecosystem becomes the primary way we interact with the digital world, does this company eventually replace the open web entirely? Do traditional search engines become obsolete? And if we are transitioning to a closed loop where one company's AI facilitates every digital transaction of your day, what does that mean for the ultimate ceiling of their valuation in your long-term portfolio?
That is a fascinating question to consider.
That is something to seriously mull over as you review your holdings this week. Stay curious, keep doing your own rigorous analysis, and we look forward to having you join us again for the next market breakdown.